Thank you guys for clicking on today's video. Today we're going to go over index funds. So basically an index fund is a type of mutual fund, and a mutual fund is a basket of stocks that people will invest in to help diversify their portfolio, giving them fractional shares for most of the major companies. Now the major difference between index funds and mutual funds is their fees and their management style. A mutual fund is actively managed, meaning a paid professional is overlooking your account and actively managing the stocks he or she controls in there. Whereas an index fund is passively managed. And another major difference is fees. Since the mutual fund is actively managed, they generally charge between 2 and 4% no matter what. And whereas an index fund, they usually charge actually between 0.02 and 0.05%, a huge difference in pricing. An index fund is a good way to track the market as well. Usually people are familiar with the Dow Jones and the S&P 500 index. Now you can't buy into those directly, but you can mimic every single stock and every single position size in those index funds, giving yourself a great diversification and not having to pay a fee every single time you buy those stocks. Since in an index fund, you'll only pay a small fee every single year. So thank you guys for watching. I hope you liked the video. Remember to leave a like, comment, and subscribe for more future content.